It's not how much money you make, it's how much you keep. Hi, everyone. I'm Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. And be sure to click on that subscribe button so you never miss a State of the Market video. Now, when it comes to dividend investing, not all dividends are the same. In fact, Uncle Sam treats dividends very differently depending on the type of dividend. So it's important to understand the different types of dividends so that you know how much you're going to make and, more importantly, how much you're going to keep. So the first type of dividend we're going to talk about is a qualified dividend. And this is the kind of dividend that most companies pay. The companies make a profit, they generate cash flow, and then they determine the proper amount to pay in dividends. And when an investor receives a qualified dividend in a taxable account, they will not pay any tax if, and this is a big if their income is $40,400 or less if they're filing single, or $80,800 if they're filing jointly. Now that's pretty sweet. There's nothing like tax-free income. If you make between $40,401 and $445,850 filing single, or $80,801 and $501,600 filing jointly, you'll pay 15% tax on those qualified dividends. If you make more than those thresholds, you'll pay 20% tax on those dividends. Now, that would be too simple, and no one has ever accused the U.S. tax code of being too simple. And as they say on TV, but wait, there's more. If you make $200,000 single or $250,000 jointly, you'll pay an extra 3.8% tax on your dividends above the thresholds we mentioned previously. All right, so you got that? Okay, so now that was just for qualified dividends. Next, we're going to talk about ordinary dividends. Now, these are also considered non-qualified dividends, another name for them. And they're taxed at your ordinary income tax rate, which is probably going to be higher than the dividend tax rate from the qualified dividends that we just talked about. So companies that pay out capital gains on investments may pay a dividend that is considered an ordinary dividend. So real estate investment trusts or REITs usually pay ordinary dividends, but again, the IRS makes things complicated. REIT dividends are usually taxed at your ordinary income tax rate, but you can deduct 20% of those dividends off your taxable income for most REITs. So if you receive $100 in REIT dividends, you'll pay taxes on $80 at your ordinary income tax rate. Okay, got it? Let's move on to partnerships. Most partnerships like MLPs pay distributions and not dividends. And there's a really important difference you need to understand. These distributions are usually a return of capital and as a result are not taxed in the year that income is received. So a return of capital isn't taxed in the year it's received, but it lowers your cost basis. So let's go through an example so you can see exactly what I mean. You buy an MLP at $20 per share and you receive a $1 per share distribution. Now you're not taxed on that $1 the same way you would be if it was a qualified or ordinary dividend. Instead, your cost basis falls to $19. Now let's say you hold the stock for 5 years and you collect a total of $5 per share in distributions. You've paid no tax on those distributions for 5 years. Now, you go to sell the stock, and let's say the stock is trading at $25. Your capital gain, which you will pay tax on, is $10, not $5, because your cost basis has dropped by $5 to $15 from your original purchase price of $20. So Uncle Sam is still taking his cut. He's just waiting until you sell the stock to do it. Now, if you hold these dividend stocks in your retirement account, especially the ones that are taxable, if they're held in your retirement account, those taxes on the dividends will be tax deferred until you withdraw the funds. In the case of a Roth IRA, however, you actually will never have to pay taxes on those dividends. So that's something to consider. If you hold the stocks in your taxable account, then you'll want to make sure that you are setting aside money to pay the taxes on those dividends, that you're not just collecting the dividends and forgetting about it, because the tax man will come knocking. You know that he will. All right, that'll do it for State of the Market this week. Thanks so much for watching, and be sure to check out my free e-letter, Wealthy Retirement, for wealth and income building tips all week long. Just click on that link below. I'll see you next week.